So this is the 200 years of market. So this is kind of like an overview, just so you guys can be mentally prepared for like what I'm going to be covering. So first, I'm going to be defining like everything that you would need to know, and some of the definitions have been covered in the other presentations, but it will just be going over it again. And then I'll be like trend analysis, so like kind of what is going on like in the market trends, um, how you like can invest, how people react to these investments in like downturns and upturns, which we'll go through in the definitions, and you can do to protect yourself against that. So firstly, our definitions. So what is inflation? So inflation is basically an ongoing increase, as you guys have heard, of prices and goods over time. And it's measured by like the general increase, not just everyday item increase. And this is calculated by cat like categorical prices being combined by a price index, like all the prices of like cars, for example, and comparing them to other time frames. And so in the pandemic, when US inflation averages reached like a high, the highest it's been since the 1840s. Everyday items became more expensive. So like in like a smaller tense, like 1 pound of or a gallon of milk was $2.91 before the pandemic, and then after the pandemic, it increased by like 50 cents to $3.47. But then in a bigger term, a new car being sold in 2019 cost 38,000, whereas in 2020 it rose to 40,000, and in 2023 it rose again to 48,000, where it remains today. Then we have small stock versus large stock. So small stock is basically companies with a total market value of 200 million to or 300 million to 2 billion. And a common misconception about this is that these companies are usually like small businesses when in fact they're just established businesses that may not be worth as much as our bigger stock companies. And this value can be found by how much you buy the stocks for, so like outstanding shares, like how many stocks there are and how much you buy them for. And examples of this are ThredUp, which is a clothing company, and Kohl's. And our large stock companies are companies with a market capitalization of over 10 billion. And this is basically every large company that you would think of. And this offers you financial stability, but it doesn't really offer fast growth. And if it's like if you would invest in a company like Meta, which is Facebook, Apple, or Amazon. Next, we have our governmental investments. So our treasury bills are short term, and you can get them as loans from the government for between 4 and 52 weeks. And so they're sold in like hundreds, and you can buy up to 10 million, and you buy it at a discounted rate, and then you receive the full amount at like maturity. So say you buy for 52 weeks, you get it back at 52 weeks. And the difference is your return. And and then we have government bonds. And this is debt security, which is offered by your governments, whether that be national, federal, or state. And the government can tax you to repay these debts if they want, but they promise to pay like the investor back. And then for market downturn, this is like a period of time when stock prices are generally decreasing. Sorry. Okay. Then we're going to go through market growth and analysis, and just like two more definitions, which will be relevant in this section. So our short term market downturns are basically when the stock market experiences like regular dips. So the market isn't going to constantly go up, it's goes. And our long term, it's like despite in the short term it might be going down, but overall in the long term it is still going up. And this can be seen in the SP 500 where today it might be red because there's a dip going on, but in the past 5 days, it's going up with some dips. And in the past 6 months, it's also going up, but the dips are noticeably smaller. And in the past 5 years, there are still definitely dips. Like in 2020, there was a big dip, but overall, it's still green because you're still growing. And this is just a comparison of everything we've gone through so far. So the dark blue is our small stocks. And you can see, as I mentioned before, big stocks, you don't get as much of growth. So you would get more if you invested in a small stock. You would, which is like 64,000. And this is just measuring like long-term growth, no matter, so you're still growing no matter if you invested in a small stock or a big stock. And in these like small dents, they might look small, but they're actually big drops, such as in 2008, there was a 40% drop, and in 2020, there was a 30% drop. And this really shows the importance of downturn protection, which I'll go through in the following slides. So basically, as like Wenbo already went through, this is like the benefits of investing early and keeping those investments and not like withdrawing whenever there's an issue. So the blue is Jack, and he invested when he was 25. And this is growing like at an exponential rate. So by the time that he's 65, he's his money has grown to like over like 5 times the amount that he started with and that he inputted. And Jill, she started 10 years later when she was 35. And yes, she didn't contribute as much, but she also didn't get nearly as much as Jack did. And that also goes for Joey. He started 20 years later and he contributed half of what Jack did, but if this were to be like, oh, if Jack contributed or like say Jack, like if you're using like the amount that Jack invested, which is 96,000, and he got 500, then Joey should be sitting at 250 for if he contributed exactly half. But because he didn't contribute for the same amount of time and as long, he only gets like a smaller amount. And this is just like showing how like people really don't see how much they're getting because the average investor only sees 2.9% of like the returns, while in reality, the SP4 500 is getting 7%. And like other things, they're getting more, but you don't really see that, but it's happening. Next are how people are reacting to this. So when the stock market dips in like short-term trends, people get scared and they see that they're losing money and they decide that they don't want to take that risk anymore. So they pull out their stocks to protect themselves and their money. However, they disregard the long-term like trends. Like how despite the current dips that we're getting, the stocks might still be increasing in the long term. So people, when the stocks are going down, people feel uncertain, and when they're going up, they feel confident and they want to invest more. So this leads to more investing when the market goes up and less investing when it goes down. This also leads to more spending when it goes up because you have more money and less spending when it goes down because you like feel like you're losing a lot of money. So this leads to the next point of downturn protection. And this is basically how if the market drops, no matter how much it drops, you still won't lose any money. So there will be like examples later in the next slide. So if the market drops like 10%, you're not going to lose 10% of your money. You will just not get anything that year. And then if the market's doing really well, like they're gaining 20%, you might only see 8% of that. So it's like insurance against your losses. So here we have like a chart. So here's account A, and account A, so every account is starting with $20,000. And account A is like steadily growing and it's getting 3% every year, no matter what. And they still get 27,000 at the end of the 10-year span. However, for account B, they win with the company and they lose with the company. So when the company loses like a lot of money, their stocks like depreciate by a lot. Like when the company loses 30%, this person ends up, this account ends up losing, oh, like they end up under the amount that they started with, which was $20,000. And then for account C, this is the downturn protection. So in the years where they're getting 9%, that's when the company is doing well. So the company could be getting, like, their stocks could be increasing by 9%, or they could be increasing by more, but this person who owns account C won't know that because 9% is the most that they'll ever get. And when it's 0%, this person also won't know that because 0% is like the minimum. They won't know if the company's like lost maybe 80% or if they've lost 10%. So they're still getting money and it's just like stable. So if something happens, it's their insurance against losing all their money. So here's my conclusion, just like a roundup of everything that we've gone through so far. So basically, inflation is your prices going up, like your car's going from 30,000 to 38,000. Downturn protection, which is the price of everything. Or wait, that's not right. Downturn protection, which is like it's like protecting you against something happening. The market downturn is Okay, the market downturn is the price of everything falling across the market, and financial growth is the time that it takes to grow, which means that if you invest in a stock and you invest early, then you have to wait, you have to take the time for it to grow. And if you pull out too early, you're risking losing out on a lot of money that you could have gotten.